Picture this. Silver was on fire, screaming toward that $95 mark everyone had been whispering about. And then, just as it touched it, the whole thing unraveled and flash prices tanked hard, shaking out billions and leaving investors reeling from the whiplash. It wasn't a random dip. It felt orchestrated, like they let it climb just high enough to draw everyone in before pulling the rug. If you've been watching silver's wild ride and wondering what the heck just happened, or if you're thinking about jumping back in, you need to hear the full story behind this move, because missing it could cost you big time. This breakdown uncovers the timing, the triggers, and why this crash might not be the end, but a deliberate reset. Stay with me, because what comes next could change how you see the market forever. And if breakdowns like this help you navigate the chaos without getting burned, smash that like button right now and subscribe for more elite capital. Decoded is all about giving you the clear, no-hype insights that keep you one step ahead. Let's dive right in. It all started building in late January, with silver grinding higher day after day, fueled by a perfect storm of factors. Geopolitical tensions were ramping up. Think U.S. carriers edging toward Iran, Trump's tariff talks heating up global trade fears, and that pushed safe haven buying into overdrive. At the same time, industrial demand was exploding. Solar panels, electric vehicles, and electronics can't get enough silver. And with supply chains still tight from years of underinvestment, prices had nowhere to go but up. China was hoarding, central banks were quietly adding to reserves, and the dollar was wobbling just enough to make precious metals shine. By mid-month, silver had already jumped from around $80 to the low 90s. And the buzz was electric analysts were calling for a breakout, retail investors were piling in through ETFs like SLV, and even big hedge funds were leveraging up. It felt unstoppable, like silver was finally getting its moment after trailing gold for so long. Then came the peak. On January 29th, silver futures touched $95 exactly during intraday trading, a level that hadn't been seen since the wild days of the 80s. Headlines screamed victory, social media lit up with memes about the silver squeeze 2.0, and for a brief moment, it seemed like the rally would carry into triple digits. But here's the eerie part: almost as soon as it hit that magic number, the selling started. Not a gentle pullback, but a sharp, aggressive dive that wiped out gains in hours. By the close, silver was back under 90, and overnight, it kept sliding, hitting 85 by the next morning. What looked like a triumph turned into turmoil, with volume spiking to record levels and volatility off the charts. Traders who were celebrating at lunch were panicking by dinner, forced to liquidate positions as margins got called. Billions evaporated, and the question on everyone's mind was, who let this happen, and why now? To understand, we have to look at the mechanics behind the move. Silver isn't like stocks or even gold. It's a thinner market, meaning fewer players control bigger chunks, and leverage is king. When prices run hot, speculators borrow big to amplify gains. But that same leverage turns deadly on the way down. Rumors swirled that big banks, maybe even JP Morgan with their massive silver positions, saw the overcrowding and started unloading. But it wasn't just banks. The CME Group, which oversees futures trading, hiked margin requirements right around that time, up 30% effective immediately. That's like changing the rules mid-game, forcing leveraged traders to pony up more cash or sell out. Stops got hit in a cascade, creating a feedback loop of selling that fed on itself. Add in algorithmic trading, where bots detect momentum shifts and pile on, and you have a recipe for a flash crash. But was it deliberate? History says yes, markets don't like one-sided bets, and when silver got too loud, too crowded, the system pushed back. Think back to the Hunt brothers in 1980, when silver hit $50 before collapsing. The exchanges raised margins then too, effectively crashing the party. This time felt similar, a controlled burn to flush out the froth. Fundamentals didn't suddenly flip. Debt levels are still sky high at over 300 trillion globally. Inflation's lurking despite Fed efforts. And silver's industrial use is projected to grow 20% this year alone. So why crash it? Because breaking 95 wasn't just a price, it was a symbol, screaming that faith in paper money is fading, and when that message gets too clear, powers that be step in to cool things off. Silver's always been more emotional than gold, exaggerating every move. Gold pulled back too, dipping under 5,000 after its own breakout, but silver felt it deeper, swinging from euphoria to despair. In the aftermath, we're seeing the shakeout. Weak hands are gone, but smart money might be accumulating quietly. Forecasts are split. Some, like Bank of America, see silver rebounding to 120 by spring. citing ongoing supply deficits of over 200 million ounces annually. Others, like Kalanovic from JPM, warn of a deeper correction to $70 if the dollar strengthens further. Geopolitics add fuel. If Trump's peace deals falter or tariffs bite harder, silver could surge again as a hedge. But right now, in early February, prices are consolidating around 87 testing supports. If it holds the 50-day moving average at 82, we might see a bounce. Break it, and 95 feels like a distant dream. Let me tell you about a trader I know, call him Mike. He's been in metals for a decade. He bought in at 80, watched it hit 95, and thought about selling but held on, believing in the long-term story. When the crash hit, he lost 20% overnight but didn't flinch. He knew these shakes are part of the game. Mike's story shows the psychology at play. Markets test your conviction, punishing those who chase highs without understanding the risks. This crash exposed how fast sentiment shifts from greed to fear in a blink. But dig deeper, and you'll see the silver market's vulnerabilities. COMEX inventories are low. Physical premiums are still elevated in spots like Asia, hinting at real shortages beneath the paper turmoil. Dealers reported halting sales during the peak, a sign that delivery strains were building. If this was a manipulation to suppress prices, it might backfire. Suppressed rallies often lead to bigger explosions later. Look at 2021's meme stock frenzy, similar vibes, where retail fought back. Today, with forums buzzing about silver stacking, we could see a grassroots push. But caution's key. Don't buy the dip blindly. Wait for confirmation like rising open interest or central bank buys. As things stand, this crash feels like a pause, not a peak. Wrapping up, remembering why silver ran to 95 unchanged fundamentals helps see through the noise. If this full breakdown cleared up the crash for you and why it might be a setup for what's next, drop a comment. Was this a deliberate takedown or just market mechanics? Share your take, it sparks the best chats. And if a friend's confused about silver right now, send them this. It could save them from a bad trade. Stay sharp, stay patient, and thanks for watching.